What will be the best investment for 2025? Buy bonds. I want to break down the stock market, which has been on a record run, hitting all-time highs just 4 to 5 days ago, and all of a sudden there's a downturn and it looks like it might hold, and we could see the stock market falling significantly from there. What do? Buy bonds. Bond investing is a great way to take advantage of the fact that our economy will likely slow down. Because the economy is going to slow down, the stock market will fall. We're seeing a shift occur right now. Buying bonds in 2025 would be the best investment, because if you buy the right kinds of bonds, you'll see those appreciate in value, while at the same time you're going to see interest income coming in via dividends with the right type of, say, ETF investments. So in this video, I'm going to break down all about bond investing for beginners, but also for anybody who is savvy with bonds. I want to break down the economy and why bonds are the move for 2025, why you should get involved in bond investing in 2025, and what's going to happen with the economy throughout. I'm an economist first and foremost. I look at everything first from the perspective, the lens of the economy. We are going to see a shift. Inflation is still pressuring higher. The Federal Reserve is going to keep interest rates higher for longer. This will slow aggregate growth. At the same time, positions in Washington, D.C. are shifting. This will slow the economy. So the eventuality is interest rates, which are being held a little higher because of inflation, will come down, and the right investment in bonds in 2025 will see substantial gains by the end of 25 into 2026. Let's break down bond investing 101 and a little more sophisticated, what I'm looking at for my bonds for 2025, what I'm buying right now. Let's jump in. For those of you finding my channel for the first time, thanks so much for stopping by. First and foremost, I am an economist, and what I evaluate is the pace of growth of the economy. That is the biggest factor that I'm looking at. Is the economy growing at a faster or slower or negative pace? And from that, the ripple effects throughout the economy and how that affects the stock market. But in this case, we're looking at the bond market. Now, anybody who's been following me for any period of time knows that I follow interest rates probably more so than anything else. Whenever I get asked the question, what's the first thing you look at when you wake up in the morning when it comes to what's going on in the markets? Interest rates, top three, all three of these things, what happened in the interest rate markets overnight, what happened in the stock markets overnight, and then there's some crypto that I follow as well. But those first two are probably the key factors. What's the 10-year Treasury yield at this moment, waking up in the morning, and did anything happen with equities overnight? Those are probably the key factors. But I genuinely have an idea as to what they're going to be regardless, because I'm constantly following the economy. There's a pace of growth in the economy. The money supply is the number one factor that I'm looking at. If the money supply is increasing at an increasing rate, this will affect the stock market and the economy. And this is one of the things that I really focus on a lot. So you're going to want to pay attention to some of the things I talk about in here. And I have some other primers that I'm putting together, and this will really help you out with regard to bond investing. Now let's move forward, and I want to talk about bond investing. I want to take a look at the concepts of the economy that you should be paying attention to, what's going on with the economy, how that'll affect the stock market, and then how that's going to affect the bond market. Let's jump into this. Changing the perspective up just a little bit here, these are the questions I'm going to answer in this video, specifically these 5. I'm going to break each section down. If you are a little more advanced with bond investing, maybe you want to drop down below into the chapter section and skip forward into whatever might be important to you. Otherwise, what I am going to be doing is breaking down economic indicators and how that's affecting both the bond market and the stock market, what we can expect in 2025 regarding the bond market and stock market. We're seeing a shift right now, and I think this is such a crucial moment for the economy and the stock market, and why bond investing is such an important factor right now. The very end, for those of you who have been following me for some time, I have been building up a very big position. I'm going to continue to do so. This is something that I fully believe in. I've been profitable and continue to grow this position and grow my profits in this specific trade. You'll want to follow along with that. Make sure to hit the like and follow button down below. And I am going to break down some of these other questions, but what I really want to kind of break into is what's going on with the economy and how that's affecting everything. Now, we're in a growth cycle right now. There are the Magnificent Seven, of course, which have been, there's something like 40% of the entire market, stock market. Not so sure what's going to happen with Tesla. Now, that's a whole different direction, and it's also a whole different kind of philosophy. But I don't believe Tesla retains its uber price to earnings ratio, which right now I think might be at 150 times. I don't think that holds. Because of that, if Tesla stock were to sell off, that would affect the broad stock market somewhat. At the same time, NVDA. Now, AI is a big subject, and the Magnificent Seven stocks have really accelerated the broader stock market. A lot of the gains we have seen have come largely from these 7 stocks. Well, what happens once we see a decline in the rate of growth of AI investments? We're on the cusp of information coming out from NVIDIA. I don't believe the pace can continue. I also believe that other factors, outlying factors, are likely to weigh on NVIDIA stock. Again, this is one of the 2 of the Magnificent Seven that we could see a shift. But outside of that, what's going on with the broader economy? We're seeing big position changes in how our country is being restructured. There will be ripple effects throughout the economy. Because of that, we're probably likely to see continued inflation, especially with the tariffs coming in, interest rates remaining higher for longer, and because of that, the stock market will likely fall. Why? What's the driver there? The economy is going to slow down. Ultimately, growth rates in stocks are driven by growth rates in the economy. This is likely to slow, and we'll see these higher than normal price to earning ratios come down. That means the stock market's going to move lower. But eventually what will happen is once all these ripple effects work their way through the economy, the Federal Reserve will be able to lower interest rates once they start balancing the concept of, okay, we do have price pressures. CPI data just crossed 3%, of course. Tariffs are going to increase price pressures even more. But once those work their way through the system, then the Federal Reserve is going to have to balance unemployment. Because of that, this will shift the focus. And once the Federal Reserve starts lowering interest rates, there's an inverse relationship between interest rate yields and the price of government treasuries. So when those interest rates come down, government treasuries will go up. This is the very beginning. We're seeing the end of the stock market move and the beginning of a bear market in bond yields, which means treasury prices will go higher for maybe 1 to 2.5 years. This is the time to take advantage of that instead of waiting for stocks to turn around. Now, there are, again, 3 things that I focus on. The money supply is probably the most crucial thing. What is the pace of the growth of the money supply and why? Where's it coming from? Right now, we're seeing an increasing growth rate in the money supply, and that's good news because it's expanding the economy. But we're seeing full employment. The tariffs and current inflation will be a drain on economic activity. Effectively, higher inflation means that consumers can only spend finite incomes in certain areas. Their checks can only go so far. Their paychecks can only go so far. Because of that, other things will have to be not purchased within the economy. And we will see an aggregate decline in the growth rate. We're going to see the money supply slow down its growth rate. Unemployment will continue to move higher. I've got charts on all these, and we will see economic growth, of course, slowing down as well. Now, here's the rate of growth of the money supply. This, for me, is the number one indicator. And if you're going to get involved in bond investing or stock investing for that matter, this should be your go-to when it comes to understanding economic indicators and the stock market. What you're seeing here is the year-over-year rate of growth of the M2 money supply. M2 money supply is the total money in circulation, cash in pockets, checking accounts, and deposit accounts, long-term deposit accounts, things like this. The whole money supply. It has a rate of growth. The thing is, as the money supply grows at a bigger rate, like what we're seeing right now, we're seeing kind of a ramp up, back up of the money supply on a year-over-year basis. Inflation follows suit. What's happening is the money supply is expanding at a rapid pace. People are getting jobs. They're spending more money in the economy. This shifts prices upward as more and more consumption occurs. Because of that, companies start raising their prices even more. Certainly look at the price of eggs. A lot of that is actually gouging. We will see inflationary pressures continue to move upward. We have just seen inflation data, CPI, moving higher again, crossing over the 3% threshold. It is coincidental to the M2 growth rate on money supply. If you want to know what's going to happen in the stock market next, you ask the question, is the economy growing at a faster pace, or is it shrinking, or is it remaining relatively in a tight range? Because consumption turns into revenues for companies. Revenues for companies turns into profits, and that drives the stock market higher. So although we are seeing sort of a last gasp on the growth rate of the M2 money supply, we're at that point where this move we're seeing upward is peaking, which means the next move is sideways to downward, especially if the Federal Reserve keeps interest rates higher for longer, continues to shrink its own balance sheet, which means stocks will move lower. Here's a look at the inflation rate. And as you can see, we were trending lower. The Federal Reserve thought they hit it. Then core inflation started moving right back upward. And this is where sort of the real issues begin with the money supply and how that will affect growth rates in the stock market as well. Inflation I expect inflation to be above 3% for a few months here. The Federal Reserve keeps interest rates where they are, and eventually we will see shifts in the inflation back downward. In the meantime, unemployment is going to move higher. Now, you can see we had moved lower in unemployment. These are initial claims. Those individuals who are filing claims for unemployment initially that week. Now, there's another indicator called continuing claims. If you want to follow that, that's a great indication as to what's going to happen next in unemployment rate. We're starting to see this trend slightly higher. My expectation here is that with all the firings coming out of Washington, D.C., with interest rates moving higher, with inflation generally, broadly speaking, sort of grinding the economy lower, we will continue to see initial claims moving higher, trending somewhat higher, and eventually crossing the 2 million mark and then moving higher. Continuing claims will follow suit. This again reiterates that the stock market will have breathed its last gasp for those all-time highs and start to move lower. Now, this is, along with M2 money supply, is this right here, personal incomes versus personal expenditures. If I took the money supply and I overlaid it on these charts, incomes is in green, expenditures is in blue in these charts, and what this tells us is simply this. As more and more people become employed, they get paychecks. And there's a rate of growth of how that works its way into the economy. As more and more people are getting paychecks, that's more and more people spending money in the economy, which means more and more revenue for companies, driving profits, driving stock prices. Vice versa, when we see a contraction, when we see more and more people become unemployed, the rate of growth of incomes declines. Incomes and expenditures go pretty much hand in hand. They've kind of moved apart from each other at this point, but they will sort of cross eventually. My expectation is expenditures, the rate of expenditures declines, which means the rate of revenue growth for companies declines. Our country, the economy, is likely to see a slowing pace of economic growth, some of that driven by tariffs. Now, the stock market. 4 days ago, all-time high. Since then, falling. What's going on here, and why do I think that this stock market will continue to fall, that we've probably peaked? It boils down to inflation and the Federal Reserve being forced to slow the rate of growth of the money supply, which means eventually we will see a decline in hiring, unemployment moving higher, incomes, the rate of growth there slowing, going negative potentially, and expenditures following suit. Plus the AI boom. We are on the cusp of NVDA reporting earnings here pretty soon, and I don't believe they continue to see the stellar growth rates that they've been seeing, and because of that, we are very likely to see a decline in NVIDIA. Tesla, NVIDIA, Apple, Amazon, Google, Microsoft, Netflix, those 7. Once we start to see those 7 become dislodged, which have largely been the reason why the stock market, broadly speaking, has pushed as much as it has, once we see those stocks become dislodged because of the growth rates start to decline, the stock market will probably, in this case, seeing Nasdaq cross well below 20,000 easily. But that's when bond investing becomes something that's important. Now, what's the purpose of investing in bonds? First, you want to grow your money. Second, the biggest thing is time optimization. Growing your money. All right, you invest your money somewhere, whether it be stocks or bonds, whether it be corporate debts or government debts, and I'll break that down in just a minute. But you're trying to outpace inflation. Right now, inflation's at 3%. So your growth rate, hopefully, you're looking at a growth rate that is above the 3% level. Currently, the stock market is only about a 3.5% price to earnings ratio yield. That's only about a 0.5 percentage point of wiggle room. Whereas the U.S. 10-year Treasury, the benchmark for all investing, that is sitting at about 4.4% at the time of this video. Meaning you're going to get about 0.9% or 0.9% increase in yield from bonds versus stocks. But there's a risk-to-reward ratio you also have to take into consideration. Beating inflation should be one of the most important things. That whatever you invest in, you're making more money than you're losing in inflation. But you also have to balance risk and reward. There isn't much more upside to the stock market because of all the economic outlying factors that will likely pull the stock market lower. So the risk levels in investing in stocks, buying on the dips, hoping for another all-time high, are much higher than, say, the risk levels for government bond interest rates. Now, government bonds, of course, have a triple A rating, which I'll explain in a minute, but ultimately, you want to balance these two big factors, growing your money while reducing your risk. So there's this optimization. Time is money is the other consideration you need to kind of look at, that you only have one day this week or 365 days in a year, however that factors in. You only get that one opportunity to invest in one thing. So balancing all these risks is one of the key factors. Now, why do bond prices move? And this is such a kind of a difficult concept to understand. And so I'm gonna kind of break this down This is actually the U.S. government bond 10-year, the price, not the yield. Normally when I have charts up, I'm talking about yields, but this is the actual price. Let's say, and this is kind of a breakdown of why prices move, and if you get this one concept, understanding bond investing will be kind of easy beyond there. Let's say there's a $1,000 par for a bond. You want a Treasury. You want to give $1,000 to the United States federal government, all right? And in this case, we're looking at the 10-year. 1,000 is the par, but what's the price? Now, let's say you have a bond, or in that case, a note, a 10-year Treasury note, yielding 5%. But I have a note yielding 2.5%. Which one is more valuable? So a $1,000 note with a 5% yield is going to get you $50, whereas mine will get you the same par of $1,000 would only get you $25. Hopefully you can see in this scenario real quick that you're earning twice as much as what I'm earning. And understanding that concept that the par remains the same, 1,000, 10,000, 100, whatever that par may be, that it is a shift in price of the underlying that will determine why price moves. So in the case of mine, if we were both to sell our bonds, I would have to sell my bond at a discounted price, even though they're both the same par of 1,000, a discounted price to what you would be able to sell your bond. That's why prices move. So if interest rates, which say the 10-year was trading at 5%, but all of a sudden yields drop down to 2.5%, your bond, still with a par of 1,000, is worth more. So as interest rates move lower, your previously issued bond with a $1,000 par and a 5% yield, your price would move higher relative to what the market is prevailing at this period of time. Understanding that inverse relation is such a key factor in understanding why bond prices move. It's a factor of we're both lending the government $1,000. But in that scenario, I'm getting a lot less interest. So therefore, the price would have to go down relative to your bond. That's the key. So when we see fluctuations in interest rates, that will drive the price of the cost of the par value of a bond. Such a key concept to understand. Now, given that, there's two considerations. Duration, time, quality, credit. United States of America, AAA. Sometimes it gets downgraded. We may see a downgrade. If the current administration pushes the deficit too far, we could get a downgrade. On the one hand, the United States of America is considered the sort of standard bearer of investment quality, AAA. You don't get any really higher in concept than what the United States government can be rated. But they can get downgraded. They have been downgraded. Certainly got downgraded after the 2008 financial crisis. But there are other kinds of bonds outside of the United States federal government. Of course, corporate bonds, municipal bonds, and there are other kinds out there. But those are really kind of the bonds you're looking at when it comes to credit quality. Now, duration, the amount of time. If you actually have a longer period of time, you could see price variations because over the course of a 10-year period of time versus maybe a 1-year period of time, it's more difficult to see what will happen in the economy. So you would see price valuations shifting more and more with longer periods of time. Consider a 30-year bond versus a 10-year note. 30 years is definitely longer than 10, and so therefore projecting that far out is more difficult to understand, and that because of that, prices tend to see wild swings over the course of 30 years. Now, basically two types of bonds. You have Treasury bonds, whether they be United States federal Treasury bonds, municipal, state, government bonds versus corporate bonds. Now, I'm a little leery on corporate bonds right now, and I'm going to show you a chart that explains why that would be coming up. When we saw the COVID shutdowns, corporate bond prices plummeted because everybody thought that the country was, or the world economies were done. If we see a substantial move lower in corporate stocks, very likely we will see an in-kind move lower in corporate bonds. Because of that, I'm waiting to get into corporate bonds. I will buy high-yielding bonds, aka junk bonds, once we see a substantial dip in the stock market, because I think that that's an opportunity in the future. For right now, however, I'm looking at government bonds, specifically United States Treasuries. Now, corporate bonds, again, this is, if right dead smack in the middle, you can see a big spike lower in the price of corporate bonds. This is the Vanguard Intermediate Term Corporate Bond ETF. This is the monthly chart. Mostly, I think this chart is peaked at this time, that because we will see a trend lower and lower in the stock market, corporate bonds, and by extension, this ETF, which is the biggest ETF out there for corporate bonds, assets under management being the biggest. Because of that, I see that this particular ETF will likely fall in price. It'd be a tough buy right now if you couldn't convince me to jump in and buy at these prices. I expect that we would see this particular ETF moving lower. I will be buying some once we do, because at that point, I'll be a long-term investor buying these bonds on the dip, taking in the interest income via dividend, and from there, eventually I'll see the capital gains I'm looking for in the price of those bonds once that selling has settled out. And maybe I pick up a couple bucks here and there. But what I'm looking at, this is the TLT ETF. This is the one that I'm moving into mostly. By mostly, with all my bond investing right now, I mean like 90%. I'm kind of playing with other things. I do a lot of trading, getting in front of economic indicators, buying those inverse indicators to this one, TLT ETF, buying inverse indicators, taking advantage of big price moves, pulling those profits out, and buying TLT ETF. TLT ETF just crossed 90 again this week, had dipped again. My expectation is that we will see price gains above 100 going into 110. 115, 120, 125 I think is on the long end, and I think that is over a longer period of time. I will begin to take profits as we move. But for me, this is the one that I'm moving into the most, simply because I believe interest rates will shift from the Federal Reserve, and because of that, the Treasury, U.S. Treasury prices will shift, and TLT ETF will move higher. Now, here's something that you may ask, should I just give the United States federal government $10,000 versus, say, buying an ETF? Bond funds are excellent because they constantly have money coming in and out, and these individuals who are running these funds are continuously buying and hedging their positions and moving money in and out. As a sophisticated investor who was a former FX hedge fund manager, someone who continuously is watching and monitoring the markets, I wouldn't do an individual bond. simply because I don't believe I can beat the ETFs, those bond funds. Simultaneously, I do other things, and it's just simply too time consuming. Bottom line. Does that necessarily mean that that's the best way to do it? Each individual is going to be a little different. Some could sit there and say, listen, I'm fine with it. I don't want to have to pay the cost. Now, some of these costs are 0.03% on a ratio, and so those are negligible to me in the long run. That ultimately what I'm looking for is those price moves from the ETFs themselves. And again, you're constantly seeing some of these bond portfolio managers buying and selling and managing those positions actively. They can outperform me easily. While every individual's situation is different, I don't see this as a way to do it for myself. Warren Buffett, on the other hand, has $325 billion invested directly into United States Treasuries. He's not using a fund. He's buying Treasuries directly. He's a little bit different. This gives us sort of a gap in between. He's looking at every single penny. I'm looking at a much bigger picture of the price movement along the way, also getting those individual dividends. Now, again, as I mentioned, TLT ETF is what I'm looking to buy primarily for now. I expect the stock market, and I've been participating in playing in the stock market with the idea that at the end of 2025, the stock market is much lower than it is today, which we're 4 days off the all-time high. That's the big picture look that I'm looking at with the stock market. Between now, the end of this year, and say 2.5 years out, I expect that we will see such a significant shift in the economy, where the stock market is, and corporate bonds, that at some point I'll be given the opportunity to step in when we see corporate bond ETFs drop significantly. And that's when I'll start switching gears, buying into those as well. In the meantime, I'm looking at my TLT ETF position as a long-term position, one that I can hold. And as I mentioned, I'm looking for a cross well above 100, going into 110. I'll probably take 50, 60, 70% of my profits after we cross 110, holding on a little bit for 115, 120, 125. I think it's a tough call to see 125 in the next 2.5 years. That I think that on the one hand, we're going to see a lot of inflation. We'll see deficits, and that will be pressure to push bond prices in a way that I don't know that we're necessarily going to see 125. But at the same time, we're also going to see those opportunities in the corporate bond markets, which I'm going to take advantage of in the future. This is ongoing. Every single month, we get brand new information from 10 key economic indicators that will affect the stock market and as well the bond market. And so this is something that will be ongoing and continuous, and that I'm going to be watching on a regular basis. There will be shifts. The Treasury bonds will move lower in price, which will drive TLT ETF, higher in price, which would drive TLT ETF higher, because the Federal Reserve will have to shift away from a primary focus of inflationary current concerns into getting more involved in looking at unemployment, that they have to balance this. And I believe unemployment, we're sitting at 4%, shoots back upward. Eventually we cross 5.25, maybe 5.5%. And the Federal Reserve has to lower interest rates, which would push TLT ETF higher. There's another factor. When we see the stock market sell, savvy investors are going to exit those stocks and buy bonds, which would push price up. TLT ETF moves up again. So there's a lot of support there. There's an eventuality that the Federal Reserve is going to have to move. And because of that, this is what will push these Treasury bond prices via TLT ETF higher. Now, I will be doing a lot of content over the course of the next 1 to 2.5 years, specifically regarding bonds and the reason why bond prices are moving based upon the economy. You'll want to make sure to hit the like and follow button down below. Also, I've written up a lot of content on my Substack regarding bond investing in 2025 and why bonds are the best investment for 2025. It's written in my Substack newsletter. Make sure to hit the like and follow button, and we'll see you in the next video.